a peer-to-peer trading. I'm selling, you're buying.
Yeah, that's how the exchanges worked. It was peer-to-peer, but actually everything was cleared through the clearinghouse. So everything would end up at clearinghouse, would be your counterparty. At the end of each day, the trades would be novated into the clearinghouse, which is a still thing that clearinghouses do today, and then they become the central counterparty. But the traders would stand in the pit and they would scream at each other. And if someone misbehaved there in the pit, then they were ignored. So you would just be, it wasn't exactly a fair market always, because if someone had done something bad that traders had considered bad, they disrespected someone, they would be invisible. So if they were doing their tic-tac-toe quoting, they would be invisible. Whatever price they were quoting, they would just not be seen. It was a very strange place. And I'll tell you a story about the International Petroleum Exchange. That is one of my favorite stories there.
Welcome to the Financial Frontiers podcast. My name is Dinos. Please remember to like, subscribe, and share this channel. It helps us create more content and deliver more episodes for you.
Quite good.
Do you also have a podcast?
Well, I did. No, I used to do radio on Radio Surrey. They used to do a thing called you'd review the news with the DJ, which is a BBC radio station, and so they'd get you to do it. And when it was being done through lockdowns, you'd have to do it from home. Okay. So I got all this kit, and then now I go into the studio to do it. Well, I haven't done it for a while actually, but yeah, you go into the studio and review all the newspapers. So you get the newspapers, you have about half an hour to look at them, and then you just talk about interesting stories.
Cool. So this one's going to start different, and I think I'm going to keep what we just said into the start of this show. And normally how we start is what I'm going to say now, and it is another session of the Financial Frontiers podcast. My guest today, Tom Higgins, a very popular name and person in the industry. I'm so honored to have you here on the podcast. Thank you so much for your time. Tom, please introduce yourself, and thank you for your time. Looking forward to this conversation.
Well, I mean, thank you for inviting me. It's absolutely lovely, and it's I'm here for the IFX Expo exhibition in Limassol, and so just to pop up to Nicosia first for this is great. It was just brilliant timing, and it's just I'm so pleased to be asked. Thank you so much. I'm an avid listener, so I'm very pleased to be on the other side of the mic this time. So yeah, I'm Tom Higgins, and I started Goldeye 15 years ago. 2008, interesting time. Markets absolutely going mad because of credit crisis going on. Banks all over the place. Everything was upside down. So I thought, well, why not start a company? Actually, it was quite a good time to start a business in foreign exchange, because in times of uncertainty, it's a little less so now, but then in times of uncertainty, people would reach out to speculation. And so retail FX is pretty much speculation. So I founded the company, started it in a little office in Guildford, near where I lived. So it was 5 minutes from my house, rather than going on a train for an hour and a half into London, which was rather nice. And and the history started there in 2008.
Yep. So, I mean, congratulations on the success. Goldeye is definitely one of the more well-known and reliable, I'm going to say bridge, but we're going to talk about how that term
talk about that
changed.
word, yeah.
Solutions in the space, one of the reliable ones, and let's get into conversations about these different products. Before we do, can you tell us a bit of a background? What was Tom Higgins doing before Goldeye started?
Yeah, so if we go all the way back, wind the tape backwards, then I did a degree. First degree I did was in electronic engineering and digital computing, as it was called then, because there were other sorts of computing. And I always wanted to be an electronic engineer. My bedroom was just full of wires and bits of stuff. So I wanted to do that. And then as soon as I graduated, I realized that actually in the UK, being an engineer was lower than low. Pay was terrible. There weren't very many jobs because we didn't really build anything here. It was all service industries. So I thought, well, I won't go into that. I'll go into something else. And so I went, they did something called the milk round then, which was basically when all the graduates would go into a big room full of these employers, and the employers would say, this is the sort of thing we do. Do you want to join? And you'd go out with, at that stage, so that was 1988, you would go out with 10 job offers. And so graduates are very jealous today that was the time then. It was an incredibly buoyant time in the world. So I came out with lots of offers and I said, I don't want to go into finance. It's boring finance, because I knew nothing about it. I thought it was like being an accountant. And actually, I became a management consultant with PA Consulting Group. And the first job I did was building an electronic trading platform for Life, the futures exchange, which is in finance. And I've never worked in anything other than finance. So I was totally wrong that it's boring. I just hadn't realized that it was actually one of the most exciting industries you could possibly be in. So I worked there for a while, and then when interest rates in the UK went up to 16 or 17%, I needed to change job to get something higher paid, because I couldn't afford the mortgage. So moved on from there, and I joined the International Petroleum Exchange and designed all of their technology for their trade reporting on their floor. So that is a traditional exchange, not like a crypto exchange, traditional exchange, but it wasn't electronic. So it had lots of traders in coloured jackets, you may have seen them on films, screaming and shouting at each other. And they would do things called tic-tac-toe. So they would touch their head one way round for buying, the other way round for selling, and the number of fingers they would have would mean the volume they were buying and selling at. And they would touch their chin for the price and that for the volume. So it was really interesting. And so they'd be shouting like this, doing all this signalling. Very similar to the signalling that you get at the bookies on a horse or something like that. And so they wanted to automate this, because it was very, very cumbersome and a lot of manual labor. And so they asked me to set up the technology. And what they did actually is they outsourced it to IBM to build this technology. So we had all these new IBM computers they'd only just designed these things that were completely new. They were called PowerPC, that hadn't existed before. And then IBM couldn't write the software. They didn't have the skills. So they outsourced that to Logica. And then the International Petroleum Exchange wanted somebody to take it forward and run it. So I joined, and within a few minutes I realized this stuff just wasn't going to work for us, because whilst it did what they'd specified it to do, they hadn't really specified it terribly well, the exchange. So I took over the code and invalidated the warranty immediately. And then first thing I did was, it was an interesting showing the power of computers, is they used to report trades back to the regulator by a room full of secretaries typing trades up on typewriters, actually typewriters. And it would take them 3 weeks to do 1 day's worth of trading to type them up. So they were months and months behind, and they couldn't keep up. I worked out that all of the trades were being keyed into a system on the floor, but they weren't going anywhere. And so I managed to automate that, so I could produce the entire day's trades by running a program. And I remember seeing the CEO, and he said, so how long have you reduced this 3 weeks to? And I said, about 2 seconds. And he was like, oh my God, that is just going to revolutionize our industry. So, but unfortunately, within a few days, that 2 seconds became the norm. So they forgot about the fact that it used to take 3 weeks. So, why can't it take 1 second? So we automated all of that, and eventually that ended up on screen, and that got bought by a company called ICE, and is now one of the largest exchanges in the world. So I went from there, went to Life, the futures exchange, as a direct employee. The first time I'd worked there was at PA Consulting Group, building their trading platform. This time I went there to build their Life Connect platform, or be in that team to design that part. I worked there for a number of years, and then moved on actually after that to Reuters. So at Reuters, I was looking after an area it was originally called Multex, and it was bought by Reuters, and it was data. So it wasn't trading data, it was accounts that had been turned into a data stream. So they'd normalize all of these accounts and turn them into a data stream.
What kind of accounts?
So it was morning notes and quarterly accounting from public companies. And so the problem is, if you look at German, so I'm told, I'm not an accountant, but if you look at German accounts and French accounts and US accounts, they'll all say things differently. They'll say the same numbers differently because they have different standards. So they would normalize all this in US accounting standards. That got bought by Reuters, so I worked there. Got made redundant from Reuters because they shut down that division, and then ironically to stop Thomson buying it, that's why they bought Multex, the company I was at, and then Thomson bought Reuters. So, and then I had my first interesting bit in FX. So that's when my FX journey started, and I went to ADM ISI, which was ADM Investor Services. ADM was a grain producer in the States that realized they had a lot of foreign exchange to do because they're buying and selling grain all over the world. I mean, massive grain producer. And so they spun off a whole trading business on the back of the fact that they needed to do these physical FX transfers. The first job I did in FX, analyzing all their trading platforms, advising them as a consultant, and then realizing that FX was where I wanted to go. So I went from there to ODL, and ODL was one of the very early retail FX brokers, and they grew at an alarming rate. They grew massively. They were the largest in the business. When I joined, there were like 20 staff, and when I left, there were about 200 staff. So it absolutely, and that was the beginning. That was really the beginning of the retail FX markets. They had their own platform, because at the time, there were really no retail platforms, which is why, as we were discussing over coffee earlier, there really wasn't a market for retail brokers. It was very, very small, because there wasn't the technology to power it. And so there was one platform called the Aerial Communications Platform, which was very expensive, and it was all manual. So a client would say they want to trade, and then the dealer would say yes or no. And an ODL used that initially, and they would have what they call a blotter. Now, if we think of blotters, we think it's a screen that has numbers flicking away very quickly of your positions. Then a blotter was a piece of paper on the table, and you had a pencil, and you wrote down, they've just bought this, they've just sold this, I've just covered it in the market with this, and they would try and keep up with the trades, which initially they could sort of manage. But you need a big dealing with lots of dealers. And then fairly soon, the trades were flowing in hundreds of times a second, and this was impossible. So then a blotter became an automated blotter, and everything became automated. So, and at the end of that journey there, they took on MetaTrader, and that really changed the business. It went from being a small amount of the business on retail FX that wasn't voice traded to almost everything. So MetaTrader 4, as it was then, totally dominated the market, and that was the beginning of its big growth. And that's when I left there and started Goldeye in 2008, and the exciting journey began.
Wow, Tom, you've packed in a lot there, so much. And, starting from 88, as you mentioned, going through all of these changes in the industry, mainly in what sounds like, and you can validate the institutional side of things. Just, I guess in different verticals within that space, just gave you the exact knowledge you needed to, start up Goldeye. And know what to hit and what to target, and exactly what kind of solutions to provide, again in the B2B space, but brokers that were focused on the retail side.
Yeah, because my exact thoughts at the time, and I do remember this very well, is there were technical solutions. There was a company called Boston Technologies that doesn't exist anymore that provided some solutions, but there was no one with any business expertise and technology expertise. And so this is where I saw our niche was. So this is why I started Goldeye, because I thought I've got the business domain understanding of how the business actually works, and I've got the technical understanding of how it all fits together and how we can build this and make all of this work. And so in creating Goldeye, I thought, well, I'll create more like a consulting company to help people buy technology, advise them what to buy. But very, very quickly, I realized that just buying MetaTrader then wasn't enough. You needed a lot more around it, because it didn't connect to liquidity providers. It didn't have any risk management. It didn't have any data. It didn't have anything really. It just had the core trading platform that you were supposed to automate trading and all bbook. So that's when we built our first product, which was actually, ironically, not the bridge. The first product was something we called the link, which was a back office connection. And that was connecting, somebody had a back office system and they wanted to take all of their trades from MetaTrader and push it into the back office system. So we built that, and then realized pretty quickly after that actually what they needed was something to be able to offlay their risk in the market. So rather than just take the other side, bbook, for some traders that were quite good, they didn't want to do that. They wanted to cover that risk first. So the concept of bridge had existed, but it really hadn't been, it wasn't terribly good. There were some poor implementations that were very unreliable. So we took our link product, the back office product, and twisted it around a bit and made it work in the way that you see a bridge now. So a trader in the market says they want to buy, a million cable, turn that into an order to go off to an LP, execute in the market, come back, mark up the price, confirm the client, confirm the broker trade. So that's the concept of a bridge, and that's what we did then.
So when you say what Link was doing as a back office is basically consolidating in in the Link environment the bbook.
It was just the books and records for all of the trades, because a bigger firm, so retail brokers don't really do this so much now, but a bigger firm would always have a separate back office system, which was their official books and records. Until it hit the back office system, it wasn't actually a confirmed trade. It was just something that had been agreed either verbally or electronically. Once it hit the back office, it was then, that's the golden record. That was a done deal. And so they would have a separate back office system that would manage all the statements, that would manage all of the interest rate charges, the swap charges overnight, for example, the rolls, and the back office system would be responsible for that. They don't really exist in the same way in retail FX now. They do exist in institutional markets. Everybody has a back office, but it's different. So this company had a back office system. They needed everything to get pushed into it, and we built the technology. It was all about translating the MetaTrader APIs, which are non-standard. They're C++ APIs. They're not fixed or anything like that, into standard fixed protocol messaging, which is what all the back offices spoke. So that was the first bit.
Right. And so Link adapted to being what we call a bridge, which
yes,
and then obviously, I know that Goldeye has other products like the MAM plugins. You also got into the plugin space, morphed into, I guess, different industries. I know today you're quite involved with the crypto side of things.
Yeah.
Prop trading, you mentioned now the coffee before. And so we're going to walk through the journey here of Goldeye into these different products based off of the experience and your initial learnings. And so I just want to mention this, what you mentioned before about the trades, buy, sell. I didn't know they were the volume and then the
that's how you do it.
That is so interesting, and it's just fascinating how people have changed and how technology has just really revolutionized a lot of areas. And what you experienced, you yourself were participated in trimming down 3 weeks to literally 2 seconds, which is incredible, right? And for those to really appreciate what you're saying, it's one thing to be told the history. I mean, I was too young to have that experience professionally, but I understand it, right? That history is really important, and you lived through it, which is great. And so 2008, you mentioned, it was when things were so volatile, the market's crashing, banks closing. You started up the business, and I think one of the reasons that it was a good time is because I guess a lot of talent was available. Pricing definitely had dropped. There was volatility, as you mentioned, and so walk us through those initial days. What challenges did you have? Did you have did you fund the business on your own? Did you need to get loans? Sure. All of those challenges that you had around the early days of Goldeye.
So, unlike most people in the technology side of this business, I didn't have a business partner. I did it on my own because I didn't have a business partner who had the right skills to do any of this sort of thing. So I rented an office in the research park in Guildford, a small space about the size of this studio, actually probably half the size of this studio. They provided some old desks they got lying around. I remember I had an old laptop, and I sat in there, and I went in on day one, set up my laptop, looked out the window, connected it to the internet, because that was a bit more complicated then. There was no Wi-Fi, so you had to hardwire it into the wall, and then thought, right, what do I do now? And fairly soon I got a call from MetaQuotes saying, because I knew them very well, saying, why don't you become our sales rep for the UK? Because very well, we don't have any people based in the UK, so you could become a sales rep for us. So I thought that was quite good, actually. So I did that, and that generated a fair bit of referral business. But fairly soon after that, I thought, actually, the big thing we can do is not just sell someone else's software, but we can add to that software so that you've got a complete solution. And the bits that were missing was initially the back office, as I said, and then the bridge part, and then all of the other products that we added on since then. So that was a bit of a revelation. I thought, actually, this is what we need to do. We need to change the company. Because it was originally called Tom IT, and I changed the name of the company after about 3 months to Goldeye, because I thought Tom IT is a bit of a silly name.
Well, tell us, how did Goldeye come? What does Goldeye mean? I mean,
we had a cat who's only just died, actually, called Pippin, and he had yellowy gold eyes. And I was trying to think of a name. I was sitting around the kitchen with my wife. We were trying to think of a name, and I looked down and I saw his eyes, and I thought, that's interesting. And gold is a universally positive thing around the world. I don't think gold's negative anywhere. And so it's a positive thing. And I for sort of internet, iPhones were coming out. So it's I for internet-y things. And then if you looked at our original logo, it had a cat's eye as after the gold eye. And then eventually that I became the dot of the I in GoldEye. So it sort of merged together.
That's amazing.
So that's sort of where that came from. And so I then started recruiting some developers to try and build more of the technology that we would need to be able to connect into the world that was evolving then.
And so this is code that when you mentioned engineer and you mentioned you built these platforms for the companies that you worked at before, and then obviously Link, I guess, which was the first product. Is it your code that the engineers?
The first one, yes. So I was a C developer and then became a C++ developer. I built the first electronic trading system in the world, was called APT and was run by Life, and it was like a video game. So it was to replace the trading floor, well, initially to augment the trading floor and eventually to replace the trading floor. And it was, you had a picture of a trading pit, which is a hexagonal shape, and then the traders would appear as icons around the pit. Unlike you see now, it wasn't order-based, it was icon-based. And if someone wanted to buy or sell, they would click on it and they would put their price and their volume and it would flash up. And then if you wanted to trade with someone, you'd click on them and then a little line would shoot between the two of you and then you've traded between the two of you. And so I built that initially, and I was one of the main developers on that platform.
Peer-to-peer trading. I'm selling, you buying.
Yeah, that's how the exchanges worked. It was peer-to-peer, but actually everything was cleared through the clearinghouse. So everything would end up at clearinghouse, would be your counterparty. At the end of each day, the trades would be novated into the clearinghouse, which is a still thing that clearinghouses do today, and then they become the central counterparty. But the traders would stand in the pit and they would scream at each other. And if someone misbehaved there in the pit, then they were ignored. So you would just be, it wasn't exactly a fair market always, because if someone had done something bad that traders had considered bad, they disrespected someone, they would be invisible. So if they were doing their tic-tac-toe quoting, they would be invisible. Whatever price they were quoting, they would just not be seen. It was a very strange place. And I'll tell you a story about the International Petroleum Exchange. That is one of my favorite stories there. Yeah. There's quite a few, but this one, so the exchange was in St. Catherine's Dock. And it was one side of St. Catherine's Dock was the exchange, and the other side of the dock were the offices where I sat. And we would have to run around the dock, there was a little walkway full of tourists normally, and you get around the dock. Anyway, we had a camera on with a little remote control, so we could see what was going on the floor in case something had broken, so we could see the technology in there. Anyway, and I got a call from Reuters and Bloomberg at the same time saying all our pricing has stopped. So the main oil pricing, so IPE priced, it was the trading center for oil in the world. And they said all our oil prices have stopped. And this was at peak time. So what's going on? And we looked on the cameras and we just could see lots of people huddling around and thought something must have broken really badly. So we went round to the floor, ran around the dock, went in there and saw they had one person who was the oldest member of the floor, is called the father of the house. And he was acting as a judge. And they had got someone on trial, a mock trial. And all of the traders on the floor, in all the pits, they'd stopped trading and they'd created this mock trial because this chap had just got married and he'd been caught having an affair with one of the secretaries. And so they decided he needed to go on trial. So for 15 minutes, the oil market stopped while they tried him. And he was obviously found guilty. It was not a terribly fair court. And his punishment was to have his head shaved so that when he went home, he'd have to explain to his wife why his head had been shaved. And then that finished, and then they carried on.
What a story.
It absolutely, I mean, it sounds extraordinary that could actually happen, but it did. And that was, you can imagine that sort of thing happening quite often there, actually.
Wow. And so, the control, a lot of control, obviously, within these people that are on the floor, right?
They were running everything, yeah. They were responsible for actually doing the deal between traders. So they wouldn't speak to the clients on the trading floor. The way it worked is you had booths around the edge where you would have people on telephones. The clients like BP would ring in, speak to the person in the booth, and then the person in the booth would signal to the person in the pit. You weren't allowed phones in the pit because it was dangerous because of the wires, and then they would signal to them in the pit, and then the person in the pit would then try and execute that order, buying or selling. And then what they would do is we put in a new telephone system for them. And unfortunately, one of the features of this telephone system that we hadn't really realized they would use was if BP called, it would always light up in a certain place. And so they would employ people to stand on the gallery with binoculars looking at other dealers' screens, the telephone systems, to see which lights were lighting up, because they knew if it lit up here, it was BP, and if it was there, it was Shell. And so they could then work out who was buying and selling, and then they could front run the market. Because if BP's coming with a big order to buy, you've probably got big buy or sell orders coming in. So they then would tip X them out, so you couldn't see the names. And then people still realised where they were on the screen, so we had to randomise where they appeared, things like that. They were very inventive in how they did these things. But anyway, that was a manual market, not electronic market, and that was the sort of the last days of manual trading before it became fully order based, where everything was matched based on I want to buy and you want to sell, and we'll just electronically match it together.
Yeah. So all of that noise, all of that chaos, all of that running around, and what was before a manual market has now been silenced into the internet.
Yes, absolutely. And because it was not scalable. The American pits, the CME, the CBOT, NYMEX, they got so big that there was supposed to be one market in a pit that was 200 feet across, and there's no way the price the other side of that pit is the same as the price this side. And so and they were so busy that the traders in these American pits, they didn't dare leave. So they would sometimes employ someone to stand in their space. And a common illness there was getting a bladder disease, because you wouldn't leave to go to the loo because you didn't dare leave your space. And so they would end up getting actually ill. It would actually, because they just would not leave. So it was a strange place, and it became it was really unfair market. So because it wasn't scalable. As soon as it went electronic and order based, then it could scale enormously. And the American markets sort of went first, and then not the oil markets there, actually, they went last, but it was the money markets, the foreign exchange. Well, foreign exchange has always been an OTC product, so it's had exchange trading, but no one's ever used it. They tried to have exchange-based foreign exchange products, but they never worked. It's always been an OTC market, a bilateral market, and because it's so big, it works very nicely. It's never needed to be on exchange.
Yeah, I mean, because if you think about it, all that volume's coming from everyday people that the banks have obviously access to, and the demand, the buy and the sell are between the institutional side, which have obviously the masses.
Yeah, I mean, the whole institutional FX market is, if we want to talk about that a bit, is a very different animal to the retail FX market. It's about 10 times the size, and the trades are very, very much larger. There's a lot fewer of them, but they're very, very large. But the vast majority of business in institutional markets is actually what's called Tom Next, so rolling from one day to the next. Because when you buy on MetaTrader, you get that thing straight away. And if you sell it 5 minutes later, you get the profit straight away. Well, the institutional markets don't work like that. They're all T+2. So you don't get your profit until 2 days have happened. If you buy cable, so sterling against the dollar now, and you buy, I don't know, what an institutional trade, $100 million. If you don't do anything with it, and you buy that against a bank, in 2 days it's going to settle, and they expect you to pay the sterling and receive the dollars, or whichever way around you did it. So you have to roll it so that it's always 1 day ahead of where you are. Right. So you roll it and roll it and roll it and roll it, and that's called Tom Next, or
tomorrow next,
or forward trading or spot trading. So swap trading. That is by far the largest amount of the institutional market, is this swap trading.
And when we talk about how big this industry is, it's whatever they say, how much per day, whatever it is, 5 or 6?
6 or 7 trillion, I think, a day.
Trillion a day.
Most is institutional side. Yeah, you see numbers in retail. It's quite difficult to validate which ones are real and which ones aren't real. They seem enormous, some of them. But anyway, but this was not available FX trading to the retail market until really ODL came along with and then launched MetaTrader as the sort of the big push, and that was really the launch of the market, and why we sort of could set up Goldeye and see the growth that we did in those very early days.
And so being one of the early participants in this industry back then, when MetaQuotes was even looking for somebody in the UK that they didn't have, you having, I guess, access to that growth, you obviously got, the insight, and then Goldeye was born. Yeah. And so let's talk then about Goldeye, because as we know, Goldeye and that what is today called the Matrix Net.
That's our core product today, yes.
That's your core product. quite a few other, well, not many, but there are, let's say, 5, 6 other, 7 maybe other similar companies who provide a similar product. Some came after Goldeye and have become bigger for some reason. Others around the same time as Goldeye, equally big. So let's talk about what that is. And today, in our industry, many individuals refer to it as bridge, and I guess bridge doesn't do it justice. So let's talk about that. And just to build the context, perhaps even for the audience who don't know what we're saying is, there is a technology layer that links up the trade that comes through from an end trader, a small retail trader who has access to a specific trading platform, the most popular one being MetaTrader. Then that MetaTrader connects with what's called a bridge into a whole massive other technology stack.
Yes.
Which serves the purpose of matching those orders either internally
Yes.
for the broker who takes on that risk on their own, or matches it onto the exchange. An order comes back, gets a confirmation, goes through. Maybe I haven't done it justice. Let's hear your description of this solution.
The bit that I would say is it's not onto an exchange normally, because the brokers, it's a market of tiers. So you've got the end trader, then you've got the retail broker, and then you'll have the prime of prime broker, and then you'll have the bank or non-bank liquidity providers. So sort of XTX would be a non-bank. The banks one would be all of the traditional, Barclays, NatWest, all of the usual ones that you'd have at the top there. And the exchanges are not providing foreign exchange trading technology to any level that anybody uses. They tried to launch it, the traditional exchanges, not crypto exchanges talking. They tried to launch it for institutional because they wanted that market, but it's never worked. Foreign exchange is just not an exchange trading market, even though it has the word exchange in it, which sounds like it should be. It's actually an OTC product, which means it's invented by the person who's providing that liquidity. So theoretically, someone's liquidity in selling cable GBP against USD is different to someone else's. But because these products are fungible, i.e. it's based on things that are standard. So if I buy a dollar from someone, it's the same dollar as I can sell to someone else. If I buy sterling from someone, it's the same sterling someone else. If I buy a CFD on something, it's not the same CFD on against someone else. The CFDs are non-fungible nearly always, whereas FX products are because they're based on a standard currency. So the way that the flow works is the end trader says, I want to buy, 1 million cable. The reason it's called cable, if any of your listeners are interested, is because the first transatlantic wire that was put under the sea from Cornwall to the States was a cable. And so it was between the UK and the States. And that wire, it was a physical wire that was on the bottom of the seabed. And there's a little hut on Porthcurno Beach where that cable comes up. And you can still go and see it. And it was very slow because it's a lot of capacitance in the wire. And that was used to signal between messages between the UK and the US. And that's why it's called cable.
So is that, when we talk about cable, we're talking about the cross pair of British
sterling
pounds,
against dollar.
Sterling against dollar.
It's known as cable because of that reason.
Okay.
Yeah.
And what communication, was that for internet communication or was it telephonic?
This was 100 years ago.
Oh, okay.
So this was telephone. It was Morse code actually.
Morse code.
Except it was probably because you have a thing called capacitance in wire, which basically means it holds on to the charge for a period of time. And the longer it is, the more capacitance you have. So if you wanted to send a blip that just went blip, just like a dot, a one or a naught, when you send it, it might be, I don't know, a quarter of a second long. When it arrives at the other end, it might be 5 seconds long because of the capacitance. So you can only send a message, one piece of information, one bit rather, every few seconds. So it's very, 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 very slow. So that's where they did invent clever ways of making it go better by having little spikes up and down, positive and negative, to counteract the. So that's why cable's called cable. Anyway, so if someone is buying cable, we diverged a bit, didn't we? Then
that was a lovely story. I loved it.
The retail broker will receive the order. Now they will have profiled all of their customers to decide whether they want to trade against their house, which is called B-booking. And actually that term was invented when I was at ODL. The ODL management had two books of customers, those that they would send to market, which they called the A book, and those that they didn't, which they called the B book. And that term has now become an industry term, B booking, which means basically you are warehousing the other side. In institutional markets, it is not used at all. If you talk about B booking to a bank, they will go, I don't know what you're talking about. If you talk about warehousing, they go, I know exactly what you're talking about.
But why the letter B?
It's just because they had groups. They had A book, B book, C book, D book, E book. They grouped their traders into different buckets of risk. And the B ones were the ones that they thought were not very good traders and they would lose money. So they would want to take the other side of them.
So A being the first letter of the alphabet, A, the default norm for us.
The back office system they had labeled their risk buckets by letter. So they had A, B, C, D, E, F, all the way down. And they basically didn't really get beyond B. They had some who were somewhat risky and somewhat not. They might put in a C. C book just generally today means something that isn't A or B. It's just sort of there. It's an unknown term, which means something else.
Oh, I'm going to ask you a question of you because I have come across the term C book, and in the context of the discussion that I was having, I'll explain to you exactly what C book was meant in that conversation. I don't know if it's actually valid. I have not had D book up until today, but C book is for dealers, risk managers, and the broker. This was in the context of the conversation I had. Any B book trade that was initially B booked and later the broker decided that they want to send it onto the market is C book. So it is actually A booked but delayed.
If you're going to have a different way of dealing with risk, that's the standard way of dealing with warehouse risk. That's what a bank would do. They effectively B book everything. And then after the fact, they will decide they want to cover it in the market. They'll never go to another bank to do the trade first, like an A booking in the broker market, because they will expose their hand. They are internalizing a whole load of trading in a bank. So they'll wait a few seconds before all of the orders have come in. They'll end up with a net position, and they might go to the market and close that. So that's become a term that's used for C book, but really it's just any other way of dealing with risk. And we have some of our clients have 4 or 5 different books that they put people together in. So they might have real retail clients who really don't know what they're doing. They might have some professional traders who've got more of a clue. They might have institutions that really, really know what they're doing. And then they'll bucket all of these separately and put them into different risk books. And that's effectively what A, B, C, D books are. But the term that has what's become to mean is A book is where you cover the risk in the market first, and then you give the client the fill afterwards. And B book, you just give them the price that you've got. But bringing that, so if we talk about B book a bit, if you have, let's look at an index, for example. So you've got an index product on, I don't know, FTSE, and the broker has taken a feed from somewhere to get the FTSE price. And that price will probably be not as fast as if you were directly on the stock exchange where it's being traded. And so if you're B-booking that and someone else has got the ability to get that price a few milliseconds faster than the broker, then they have got a latency arbitrage opportunity. So they know exactly where the price is going to go. So they can go in, buy and sell, buy and sell, and buy and sell, and they can make as much money as they want because they know where the price is going in a few milliseconds. And sometimes it's longer than milliseconds. Sometimes you might be half a second in some brokers in the world. And so there's real arbitrage, latency arbitrage risk in that example.B-booking brings all sorts of risks. Initially, because MT4, Metrotrader 4, was only top of the book, people who wanted to trade large size, where typically you would get a worse price as you're going down the book. Because one of the first things I learned in this market is if I go into a shop and I ask for to buy a large size amount of something, I'm going to get a discount because I'm buying more. If I'm going in FX and I'm buying a large amount, I'm going to get a worse price because the risk is higher. And so it's the other way round. Whereas if you've just got a top of the book price and I say I want to buy 10 million of something and I just go buy, I'll get the top of the price every single time. And the basic built-in B-book functions that you'd have in MetaTrader would give you that price every single time. So the broker then has to cover that risk if they want to. At a proper institutional price, and they've lost out big time because the prices will get much worse as you get bigger and bigger and bigger in size. So we built an awful lot of technology in 2 or 3 years ago, which we call broker protection, for example, where as you trade more, you can make the price go wider as the person goes buy. So you can simulate what's happening in an A-book model, or you can slow down their executions so that each execution happens a little bit slower if they are absolutely shotgunning you. So you can do, they call it speed bump technology, so that's what we call it anyway in our world. So we can protect the broker against being hit. And we had a broker the other day that just implemented our technology. They got hit with 30,000 orders they put in. So they put in 30,000 limit orders, all to hit them at the same time, all at the same price. And our system basically shut them down, stop this trader doing all of this, and stop the broker. He reckoned he would have lost over $1 million in that scenario. So it's not something to think, oh, I don't really need that. You do need that. And if you are a new broker appearing, these type of traders will hunt you down, and they will find you on the internet, and they will steal all your money. It's not difficult for them to do this. The algorithms that you can buy off eBay, to do this, it's not very difficult.
But you'd need access to that price directly on the stock exchange, right?
Yeah, and it's not very difficult to buy that. So you can get, it is now quite cheap to buy exchange price feeds, either direct or you get it indirectly from someone who's got access to it, and it's very, very common. Trading around news as well. There's all sorts of things people can do. And we built a whole platform called Visual Edge, which is a risk management tool that analyzes client trading in real time. And then within a second of any activity, it will alert you. So it's got, I would say, early versions of AI built into it to look for patterns, trading patterns, and then alert you what's going on. So it'll say this person is doing this sort of trading, and it will then flag them and highlight it to you that you should look at this, because either they're making too much money, and if someone's making too much money or losing too much money, there's probably something wrong. If they're losing too much money, they might just be a rubbish trader. If they're making too much money, they could be a really good trader, but it's unlikely, because if they're just all retail traders, they've probably got some sort of unfair advantage. So you should probably investigate and have a look and see what they're doing. There are all sorts of things, telltale things, like they'll buy 0.001 lot, and then they'll buy 0.001, and then buy 0.01, and then 1. And then they increase the size as they're testing their algorithm to see how much they can get away with. They'll buy and sell between different accounts. So one account will buy, one will sell. I mean, that's a money laundering technique, actually, that people use. So they can show whoever is saying, well, where did you make all this money from? They show the broker that's winning and not the one that's losing. So they just buy and sell over. So there's lots of things. Anyway, Visual Edge is used by quite a lot of brokers to sort of spot that type of thing. Use that in combination with the broker protection we put in MatrixNet, and then you can have a very tight ship.
So you got MatrixNet, broker protection built into MatrixNet, Visual Edge, which is a risk management solution that kind of plugs into...
It reads from MetaTrader 4 and MetaTrader 5 and other platforms that have a SQL database, and it consolidates everything together with one HTML-based screen. So people run it in two ways, and they normally run both at the same time. They'll have screens around their dealing room showing in real time how much money they're making, what their how much position they're building up in certain portfolios or pseudo portfolios, so they can add all the stocks together or add all of the indexes together in certain ways and show the risk level there, show how much money they've made from yesterday to today, see which traders they think are the most dodgy. They can have a screen showing who is making the most from the broker. So if it's all B-Book or it's mostly B-Book, you can see this is the most winning trader, then the next one, then the next one. And that's a good sign of who you might then want to look into, make sure they're not breaking the rules and they're playing fairly. And that's pretty essential. And then they'll use the screens in analysis mode, where on their desktop they'll log in and search for things and look for, you can do B-Book what if. So you can say, what if I was to A-Book these people instead of B-Book them? How much money would I have made or lost over the last 6 months? And it will even suggest, it'll say, by the way, we suggest, based on the trading activity, that this account should be A-Booked, this one should be B-Booked, and this is how much you would have made if you'd done that. And then you can look into it a bit more to know whether that's real or not. Because some analysis, some people use other people's accounts, in which case it can get a bit confusing, because you think you're looking at a certain person, but actually it's someone using that person's account. And the last bit is the MAM, really. So that's one of our key products as well, so money managers. So I mean, if you don't know how to trade, you go to someone who does know how to trade, and you give them your money, and you sign a power of attorney, and they trade for you. And that's
portfolio managers.
Yeah, that's money managers. Yeah, exactly. And it's very, very, very common, and it's quite difficult to do reliably in MetaTrader because it was not designed to do that. But that's what our software does. It's managing the trades between the sub accounts and the master accounts.
So going back to what you mentioned before, this massive risk, obviously, and what broker protection is built to protect brokers on is mainly the B-Book trade. And so if I were a broker, I'd come in and ask you, okay, Tom, that's freaking awesome, but let's just, it just sounds way too risky. And until I can put your technology to test, what do you think about me just booking everything? Does that cover my risk?
It covers your risk somewhat. And this is a shock that happened when the Swiss depegged,
Yes.
because people didn't realize in the larger companies and in the sort of banks and places like that, that actually it's not risk-free retail. Even though it's a book and your net position is flat, you're not actually flat. The client has a position with you and you have a position with your liquidity provider. So if the price goes massively one way, as it did when Swiss depegged, your client might owe you $100,000. Now, they don't have $100,000. They're wiped out.
But then there's also negative balance protection.
Well, that became in because of that.
It wasn't enforced.
It wasn't enforced at all. No, nobody did it. So your client owes you $100,000. You owe your liquidity provider maybe $90,000. Your client can't pay you, so you still owe your liquidity provider $90,000.
Otherwise, you go out of business.
Exactly. So, and you have to pay your liquidity provider. You can't not do that. That's a bank. You can't do that. Whereas your client will not pay you. They'll just disappear. So they realize it's not risk-free at all. And so it's really important, even if you're booking, to see how your positions are building up against your clients and your liquidity providers. So we can show how your position is building up against your LPs and your clients, because you really do have a risk there, which you sort of didn't realize.
So how would these technologies today, let's say was that a black swan event? Let's call it a black swan event. How would the technologies today protect a broker against a massive, unexpected swing on one side that's 100% booked?
One of the things the regulators did was reduce the leverage from almost any amount to 30 to 1 generally. I mean, they vary around the world. The regulators started operating together in unison globally, which they'd never done before. There was regulatory arbitrage. They'd compete with each other for business. They started talking to each other, which was very annoying, and generally having a consensus to stop risk moving around the world. So really the only way you could have enormous leverage was to go to an unregulated broker somewhere. Which clients don't really want to, because they don't have any protection. So by reducing the leverage, it reduces the effect that would occur of a very, very, very large price change. Of something like that happening, there's almost nothing you can do, because it was unknown. They deliberately didn't tell anyone because they didn't want to spook the market, and it was completely unexpected.
I remember
the biggest one I've seen since then was cable changing when Brexit happened, when they thought Brexit wasn't going to happen. When I watched it all night because it became clear, and it moved an enormous amount, not as much as when the Swiss depegged, but it still moved a large amount. But because people knew that was coming, the Brexit vote, people had gone risk off massively. They'd taken all their positions off. So the effect was nothing, because they thought, this could be bad. So we'll just all take our risk off. And then it didn't really affect people. After, of course, Brexit has had enormous effect on many businesses, the UK particularly, because not being in the European passport anymore for regulation means we're not such a good place to do business, but that's another story. But I mean, what is interesting, I think, in the world that's developed now is how new asset classes have come in, like cryptos, and where that's really changed so quickly. If FX went quickly, cryptos is going at 5 times the speed.
So let's talk about that a little bit, because you've obviously gotten quite involved with crypto. You obviously see something there. And
yes.
Let's hear around what you're doing today with crypto, and where do you see this market expanding?
Well, if we sort of start from when we got involved in it, so about 6 or 7 years ago, when Mt. Gox was around, if you remember the name, that went pop, and there were lots of others. I think we were approached by a client who wanted to list Bitcoin that was trading at about 5 cents or something. Then painful. Then I wish I'd bought some. And they wanted an accurate price for Bitcoin, and we integrated a couple of exchanges just for pricing, and they were so bad and so unreliable that we ended up having to do 9 to get a reliable price, because they were so bad. I mean, they really were awful. Some were delayed by hours, the pricing. They had no phones. You couldn't speak to them. They would change their APIs daily. Just literally, they wouldn't tell anyone. They would just change their APIs, and then it would stop working, and then you'd have to rebuild. So it was awful. So we thought, well, this is not a good start. The way we work with liquidity providers is completely different. We're not expecting to have someone you can't talk to and unreliable pricing, and God knows what would happen if you deposited money with them. You'd never see it again. So we sort of backed off a bit on that. And then the market evolved a bit more, and market makers became involved in the spot product, OTC market makers. So that got interesting again. So at that point, we thought that this is a viable market. So we integrated with 27 market makers, because there were lots then, and a clearinghouse called the FXCH, which was a clearinghouse for cryptos. It started out as an FX clearinghouse, which is why it's called FXCH, and then it stopped clearing FX mostly and started clearing cryptos. So we provided that, and we had a few customers using that, but it wasn't very evolved, and the market was okay. But then the market collapsed. The first crypto winter came along, and most of the market makers sort of disappeared and they stopped trading. It all went a bit quiet. Then we had a bit more activity come back, and it got a bit more exciting again, and some of the exchanges started getting a bit more sensible, and so you started seeing some, Coinbase, Bitfinex, and Binance, not really at the time then, it was a little bit early for them, but others coming in that were Kraken, that were a bit more sensible, that you think, these people are taking a bit more seriously. Their technology is more reliable. They do have some form of client support. So they're starting to go in the right direction of being a viable opportunity. So we integrated with some of them. Then the next crypto winter came along, which was just like, will this stop happening? And then we carried on building stuff in a crypto space, but probably a little bit less in the crypto space than more in the FX side. That's sort of when we were working more on the broker protection and that type of logic for a foreign exchange. But then a real game changer was when Hidden Road came about. So Hidden Road is the largest prime broker in crypto, because there hadn't been a prime broker before. There'd been people who called themselves prime brokers. There weren't really. And even Hidden Road as a prime broker is different to an FX prime broker, because an FX prime broker, that you give up the trade after you've done it, and you don't have any credit risk with the person, as in pre-trade credit. Whereas with Hidden Road, they are your counterparty in everything from the beginning. So you only paper with them, and you can trade with any of their counterparties without you having to do anything. But what they don't have is aggregation of pricing. So you can't send an order and get it filled in the best place as you can with, say, in the FX market with our aggregation technology. So we took our MatrixNet product and we integrated with the big exchanges and all of the market makers, and it's mostly a different set to the original ones. They use WebSockets, they use REST, they don't use FIX generally, so we had to do different protocols that other people didn't support, and they didn't support FIX, so we had to do all those adapters into the different protocols, to the point where we had a really, really interesting technology stack for people who wanted to consume institutional only crypto liquidity in large size. So say you wanted to be buying and selling 100 Bitcoin. Before, you would have gone to Telegram and you would have done an RFQ and said, I want to buy 100 Bitcoin, what are you going to sell it to me at? And then there'd be a bit of arbitrage, a bit of arguing, and you'd get a price. Whereas ours, you have a streaming order book with full depth, and you can see exactly what you're going to pay. You submit an order to buy 100 Bitcoin, and it gets broken up into parts, goes into the market, executes, and you get your fills back, as you would in any other traditional market, now done in cryptos.
So when you said market makers in the early days, and then afterwards the exchanges, you gave some examples of exchanges: Coinbase, Binance, and the like. Mm-hmm. Market makers, examples of market makers.
So market maker, JB Drax, Jane Street, XTX. Okay. So they are futures market makers generally. That's where they've come from, and so they moved into the crypto world because they realized they could use their somewhat of their technology, but definitely their expertise in making a price. So what makes you a market maker is it's your price. You're not just taking someone else's price and pushing it out. You're making your own price. You'll say, I will buy and I will sell, and these are my prices to buy and sell at. And you're not obliged to make those prices as you are in, say, the equity markets, but you're expected to honor those prices.
And that's the term, right? I'm making the market.
Yeah, you're making the market. And in the equity markets, you have nominated market makers who it's their job to make a market in that stock. And then you'll have secondary ones who have to back it up if they can't do it, or to add liquidity, and then third and fourth ones as well. Whereas in crypto, the term market maker and the term exchange are completely abused. So you get people who call themselves an exchange that aren't an exchange at all. They are just a liquidity aggregator from market makers.
Yes.
And you get people calling themselves a market maker who aren't at all. They're just really selling someone else's price. It's all liquidity of some sort. And it all behaves in a strange way. roughly like FX, but not entirely. And so we've built really clever technology to be able to make it usable. So things like a typical thing you'd see in the crypto world is someone is they want to trade more than anyone else. So they will have the best prices in the market at the top of the book. And it's like their shop window. When you try and trade against them, they'll either slip you every single time on that order, or they'll reject you because they don't want to. If you say I'm only prepared to take that price, they'll reject you. So they're basically hogging the top of the book, which is a no-no, because the book should be, this is a representation of what you would get if you traded now. So we have logic called sin bin logic, which measures the performance of the market makers, and if they are doing that sort of thing, then they will be suspended from the book. And then they might go back in later on because it might be a technical fault that's causing it. And if they do it again, then they're permanently taken out of the book until the broker who is using that service could then have a conversation with them, say what's going on, and then put them back in again if there was if it was a genuine problem, rather than actually they've decided to run their business in that slightly naughty way. The other thing they will often do is they'll publish a price with a volume, and if you try and hit that volume, it's just not there.
Yep.
There's much less volume there. So you've got to be able to bring all that together. So we've got intelligent retry logic where you'll try in a certain way, and I don't want to give away our secret sauce, but basically we'll then have algorithms that will try in a different way to achieve that same thing. So all you need to say is I want to buy 100 Bitcoin, and it will then do its best to try and execute that. And this is then really taken a step from being a liquidity management platform to being an EMS, an execution management service. So you tell it what you want to do, and it's taking care in lots of clever ways of how to achieve that, rather than just blindly sending something out to market. And that's really a big growth area for us now, because the institutional crypto world is developing very fast, but in exactly the traditional finance way. So of segregation and separation of responsibilities. So where you have someone who's responsible for custody, someone for clearing, someone for execution, and you're splitting up the responsibilities that way.
Well, it's interesting because obviously in a space like this where there aren't many options, and for example you brought Hidden Road, right? And I'm pretty sure that the majority have not heard of Hidden Road. They don't know it. Obviously being in the B2B side, on this side of the fence, you know about Hidden Road. I have heard of Hidden Road before, and it's interesting how I don't know who they are, I mean personally, and how they've gone and chosen the protocol to be WebSockets or REST API, where if you strictly speaking, it is a financial product, and maybe it would have made more sense in my mind. I don't know if I'm missing something, but to be fixed, to follow the fixed protocol, right, and have the tags, the comp ID,
They didn't choose WebSockets, I should say. It's the exchanges that chose WebSockets.
Okay.
So they have to work with WebSockets when they talk to an exchange, and they have to work with the exchange's wallets, APIs, to talk to them.
So it's a whole other
which
world.
Is another world,
yes.
Because that's what the exchanges do, and then they started with the exchanges. Market makers tend to work with Fix, actually. And so Hidden Road don't I mean, when we integrate with them, we don't use Fix at all for them. They have REST messages that you have to use REST to send JSON messages. So you format a custom message to say this person has traded with this person at this price and this was the venue, and then you drop copy that to them after every trade.
And I guess you can just replicate what's built into the fix, right? You just put
they have the drop copy is more like you would do into Triana or something, a post trade clearing system, a netting system. Because it's a similar sort of idea. So it's quite complicated actually how you do this, and it's totally different protocols. Where the WebSocket comes in is because these exchanges, the crypto exchanges, didn't come from the traditional finance world. They didn't know even Fix existed, I think.
Exactly.
So they started with the sort of thing you would use to build a web page that you had prices moving on, which was WebSockets.
Two-way communication at the same time.
Yeah.
That's what WebSockets.
Yeah. So you build a WebSocket and you poll it every now and again. I mean, they're not as fast or as efficient as using Fix, because Fix is designed for very, very high speed trading. Or if you want to go above that, you go to binary protocols. There's ones that are even faster than Fix. But so we've had to work with Fix when we talk to an exchange that talks Fix, and WebSockets when they talk WebSockets. Binance doesn't have any Fix. And someone from Binance said to me that institutions will move to using WebSockets, and I'm afraid they're wrong. Institutions do not move. People move to the institution. Yeah, they are too big to change. So therefore, we see people come to us who say, okay, we've got this client. They want to use Fix. We only do WebSockets. and we can sit in between. So we can just do a fairly simple translation layer in between. And LTB, for example, in Asia, only support WebSockets on everything. They've got clients queuing up who want to use Fix, and so we've got a great solution to be able to do that on either the taker or the maker side. But the aggregation has come from what we did in FX. So supporting aggregation across all the FX providers, you didn't need to do all that clever sin bin stuff in FX because it's not necessary. Retry is useful, but again, you generally get what you've asked for the first time. So it helps if you're doing size, but it's not necessary in the same way as in crypto, which it's essential. You can't really function without it. So we found other people have gone to some of our competitors who concentrate entirely on FX and said, oh, well, it must be the same. It isn't, and it doesn't work. So I think we've put an awful lot of intellectual effort and sweat into building our technology stack in MatrixNet for the crypto side as well as the FX side. And I love both sides of the business, actually. They're both as interesting as each other, and they come and go in bursts. The most recent thing that pushed the crypto stuff were the ETFs. Because the ETFs guaranteed that there would be large amounts of money flowing into the
BlackRock,
system. Right? Yes. So the reason that it's helped the spot market, the underlying market, is if you have an ETF and it's covered by using spot products, this ETF provider has got to go and buy billions of Bitcoin. And so therefore you've reduced the supply of Bitcoin, therefore you've increased the price and you've increased the volatility because there's more trading going on. So it's really, really supported and helped that market. Payment industry as well as another thing that's really interesting, because in FX, using FX for moving money around and using FX for speculation or hedging are completely different. If you get paid in dollars by one of your clients and you want to turn that into pounds, you don't go to FXCM or something, who are a trading house. You go to someone who's whitelisting Barclays platform or something. In the crypto world, it's completely different. It's the same platforms that do fiat to stablecoin, fiat to Bitcoin, stablecoin to Bitcoin. But there's no different. There isn't really a need to be any different. There's no T+2, it's all instant. So you don't have that problem. So there's no roles, any of that sort of side of things. In fact, one thing that is a bit weird that we've had to do, and we built a product to do this, is the exchanges, so the crypto exchanges, rather than charging interest daily for their CFD products, they charge interest hourly. And they change the interest every hour, depending on what's going on in the world. And some of them want to do it more often than that. So we've had to build an API to talk to the exchanges to pull their interest rates and apply CFD swap charges rather than daily. We apply them hourly, or however often the exchange wants to apply them. And they could vary dramatically from 5% to 1%. They change. You can't just have a sort of guess. They are hugely variable, and it's unusual.
And this this interest rate comes in from holders of crypto assets that want to leave their money where these, I'm going to call them exchanges, you can correct me if I'm wrong, paying interest.
No, it's a different thing. I'm talking about CFDs. So in the crypto world, they call a CFD a perp because CFDs are illegal in the States, but futures aren't. So if you call it a perpetual future, it is a CFD. It's just got a different name, but it becomes acceptable. And so perps are a leverage product. And so if you've got leverage, effectively, if you've got a leverage of 10 to 1 or 5 to 1, they're effectively lending you that money. So you've got the money for the 1, but if it's 10 to 1, they've lent you 9 times the amount of money you've put in. And they are charging you an interest rate for that money, which in CFDs is swap fees. So every day you have a position open, you get charged. And they, because it's so variable, the rates they want to charge, this is where instead of charging it daily or calculated daily and charged daily, they will do it hourly. And so you've got to be able to know what the rate is. So if you're, as a broker, offering out Bitcoin from Binance, and Binance are changing the rates they're charging you as a broker every hour, you've got to be able to reflect that. And so we will then apply swap charges. We will get, if it's MetaTrader 5, for example, we won't let it do its normal swap charging daily. We'll replace that with our own ability to do it every hour. And that's just another wrinkle of the crypto world that is quite interesting.
And also that it's 24/7.
That's another hassle, yes. Support is a thing. You've got to provide people to support it 24/7. You've got to have a system that can run 24/7, which sounds like that can't be too difficult to do, but a lot of the early FX systems were built to run in batch mode. And at weekends, they were built to not run, to be able to do maintenance. And so they can't run 24/7. We built ours to be continuous just because it was sort of easier. And so that was, I guess, a lucky choice that we didn't have to do that. You allow an hour downtime a week for maintenance in case you need to do some system work. You don't normally use it, but it's always something that you would allow is an hour downtime. But typically, if you were going to do a maintenance or something, it might be a few minutes or something like that, but you would generally contractually allow an hour downtime. So you've got that. You could say, well, I just won't offer it on the weekend. But then what happens if your client buys on a Friday, something dramatic happens over the weekend, as soon as the market opens, they're in a bit of trouble. So, and they can see the price changing. The thing about FX is nothing changes over the weekend apart from the odd venue that has weekend trading. There's not many do, but the odd one does. Then you just wait until the market opens.
And so gold's positioning on this exchange, this crypto product is, you see something happening there, you've built and integrated with different exchanges, market makers, aggregating a price and basically replicated what exists in the FX world with depth of book, top of book, with all this aggregation that's happening from your technology stack, and then whatever you integrate, whether it's a trading platform or I guess more market makers moving forward as they start growing, I guess. That's what you essentially created here.
Yeah, there's more than two sets. There's two areas of customers that are primary focus. There's takers of liquidity, and those takers could be brokers. They could be prop firms, as in not in FX prop firms, but people proprietary trading. The original definition of prop firm, which is just, it's my money and I'm trading on my own basis. The FX prop firm is another thing we probably should talk about, which is like it used to be called an arcade, actually, in the original FX days, where you would sponsor someone to trade when they proved that they could make money. So those sort of firms, and then people who want to then sell liquidity. So people would use our technology to source liquidity from all of the exchanges, market makers. They would work with Hidden Road or LTP, and then they would create their own price streams, their own liquidity, and they would then sell that out to other brokers who then might consume that themselves or might sell it on further down the chain. So you've got, again, the hierarchical model that you have in FX, and that's very popular to do that sort of thing. There are other wrinkles in cryptos that are things that we didn't really realize at the time that you sort of come about when you put it in place. If we had, so one of our clients, we had, I think it was 13 liquidity providers because they wanted very deep liquidity. That would generate, on average, in one asset, so Bitcoin, over 13,000 price updates a second, which is extreme.
Yes.
And most downstream providers probably couldn't cope with that level of things. So things like that, and if you multiply that up and you had 100 coins, the scale is too big, and most people can't actually support that. Yeah. So you have to be able to take account of the extremely high data rates that you're getting out. The reason it's so high is because if everything is sourced off the Bitcoin price changing on Binance, for example, all of the market makers are all adjusting their algorithms in real time based on something that's changed earlier on. And so they all price at the same time. So you get these massive spikes of updates that are extraordinary that you don't get in the same way in FX. It's much more controlled. So you have to have intelligent throttling to be able to deliver a lower data rate to people further down the chain that don't want to consume that rate because they don't need it, and it's just expensive to push in bandwidth to say send all that sort of stuff out. Nice. So there's lots of things that we sort of learned there. But yeah, that's very interesting, and it's an API only based product. So we don't have trading screens. Other people use screens like DevExperts, MetaTrader, CTrader. There's quite a few. DevExperts have made a real push, actually, interestingly recently, in their front-end technology, and they've had a big growth, actually, and we partner with them quite a lot, actually. We're quite a few joint clients. Very, very good company, actually. We've worked with MetaTrader obviously for years and years, and their technology is very, very good indeed as well. It's the standard. It's the sort of gold standard that people work from.
Yes.
But some people want something different. So.
Let's talk a little bit about prop trading.
Prop trading that isn't prop trading, that's called prop trading. It's called proprietary trading for some reason. I'm not entirely sure. So we talk about what it actually is.
Yes.
What they actually do. So what they're actually doing is they're saying to someone, okay, you prove that you know how to trade, and you're going to pay me a small amount of money per month to prove that you can trade. And then if you prove that you can trade and you're good enough to make money or not lose too much money, then I will put you on what is called a funded account, and that funded account will share how much money you make and we make. So we will fund that, and we will split the profit with you. That's generally how most of them will work. So the first bit is unfunded, the second bit is funded. The first bit is often called a challenger account, so you're proving that you can trade. The second bit, okay, you know what you're doing, we'll share the profit. I mean, what a brilliant model. So you get rid of all the people who don't know what they're doing, you keep the people that do, and they make money for you, and you just make money. What a great model. So it's an interesting one. It's fraught with danger, and also the opportunity for sharks and people to get in. That's one of the problems with it. So that's why, to some people, it's got a very bad name. Fundamentally, it's just arcade trading, and there's nothing wrong with it if it's done properly and it's managed properly. And it is extremely popular. Extremely popular. So we've done partnerships with lots of different people. There's a company called FPFX that provides CRM. It's called CRM. It's a lot more than that, but technology to manage the challenger stroke funded part of it and monitoring all of that. They don't have their own front end. They work with other people's front ends. They don't have liquidity management side that they would use our stuff. Typically in FX, but we're starting to see it more in crypto as well now, because if it's an asset and it's volatile, why not do it in that? It doesn't make any difference now as long as you can cover the risk somewhere. That's an interesting growth area actually.
And so, since you're veteran in the industry, there was obviously different forms of proprietary trading before this. I guess let's call it this new model of hunting for great traders that exist around the world. And so these great traders obviously made it through I guess universities, interviews, whatever it is, into trading houses that knew how to trade, and then you traded your money. So yes, let's hear about your experience about what the original, how that looked.
So the original model, the arcades,
yes,
none of them would have gone to university. These were people that were from the fruit and veg markets.
Okay.
So the people that worked on the live floor, they used to sell produce on the markets. They really were. They were called barrow boys because they worked on the barrows selling fruit and veg, and they had the ability to speak fast and to be able to trade and understand numbers quite well. So they were very numerical, but I doubt many of them would have A levels or gone to university. It's not those sort of people. And so
practical trumps the theory.
Yeah, exactly. So the sort of people that would have been in an arcade would have not had an education at university at all. They would have been people that knew people on the trading floor that said, I know how to trade, and they would say, okay, you come in here, it's a room. Then you didn't have the internet trading at all. I mean, the internet didn't exist then. So you would have a room full of computers, and you would sit in front of your computer. You would be given a certain amount of money to play with, and they would see how you performed. And it was real money generally then, because they didn't have the concept of B-books. So you'd be trading to seeing if you, normally on futures markets, can you make any money? And once you've burnt through your cash, if you've made some money, they might give you another chance. And if you did, then they will fund you to trade and split the profit. But you'd physically go to this arcade, this room, which was very expensive to set up because the computers were very expensive. The rooms were expensive because they were all in the city of London. So it was a very expensive thing to do. But they were, again, pretty popular, these arcades. When electronic trading came about, it wasn't really necessary because you could do this from home more. And then when internet trading came, you didn't really need to do it because anybody could do it. But then there's sort of idea of someone making money out of someone else who can trade but doesn't have the, I suppose, the wherewithal to be able to fund an account was quite clever. Because if you're a really good trader but you don't have any money, what are you going to do? So the prop firm works quite nicely because you've got a little bit of money to pay your 50 quid a month or whatever they charge to try to prove you're good, and then you don't need any money because they're going to fund it with their money and share the profit with you. So if you make money, you make money. If you lose money, I don't know quite how they work. All of them, they work in different ways on whether you actually have to pay that you've lost or whether it's a more like a high watermark level type system. But yeah, interesting area.
And so how does the likes of Goldeye and your technology, what adaptations have you needed to make to service that model?
So there's a number of different things. One is a commercial model. The way we charge for the services has to be different because you can't charge, and we don't charge anything for the challenger accounts. So the point where you're being proven, so that you might do vast volumes in trading for that, but we don't charge for that because it wouldn't work. It's not real trading either. It's testing trading. So so we have to be able to adapt our commercial model, and we have to adapt our charging system to the billing system to be able to work out what is challenger and what isn't challenger, to be able to work all that sort of thing out. we have to be able to integrate with different trading platforms, because it's a market where there's not much MetaTrader, because MetaTraders don't like prop trading. Therefore, there's lots of other platforms. So we've done more integrations with other platforms and seen more growth in other platforms than we would have done. So that's a sort of interesting area. It's not a huge amount of change. The risk management, generally, I don't think we've had to make many changes in there. I think we had enough because it was pretty broad, our risk management platform visualization. There was enough in there to be able to monitor this. It doesn't do what something like FPFX does and monitor when you're a challenger and when you become funded and all that sort of stuff. We're not looking at that space. We're looking about aggregation of liquidity, and providing that in the right way across a whole lot of different asset classes at the right performance and the right price, really.
Yeah, because it makes sense that the trading behavior of somebody that's participating in an evaluation and is trading money that is not theirs. So obviously a lot less risk. You got $75,000, for example, or $100,000 at your disposal. With a 200 or 500 euro, whatever it is, a subscription fee for that, or whatever fee, registration fee for that money. And so your trading behavior is obviously going to be very different had you put that $75,000 or $100,000 of your own money.
That's why you've got to prove you're good.
Yeah.
But then some of the firms, I think, are just about making that $75 a month and just having lots of them. Right. And they don't really care whether you make money or not, and they book everything. Yeah. And there's others that are more of the arcade type model, where they really do want to find people who know how to trade, and they really do want to use them to make money, and they will very closely monitor them.
It is a very interesting space, currently unregulated. It's also interesting how regulation is going to change it. Right, it's going to adapt.
Yeah, regulation always comes afterwards, because they sort of follow up. It depends how much of a bigger problem it is, because the regulators can only deal with a certain amount. They only have a certain amount of bandwidth to deal with problems, and so if there's something else that's bigger, then they will deal with that. And I guess they're probably all concerned what's going to happen with the UK election, when Labour will almost certainly get in, because of just the numbers in the polls just make it impossible. Pretty much any other decision, they're double ahead of any other party now. So that's going to change quite a lot of things, and they're probably they'll just wait for that to see what that brings about.
Tom, we've been speaking for quite a long time here. It's been more than an hour, actually, and
it feels like 5 minutes. Just flows by.
It just flies through. So I think with some closing comments, what does Tom Higgins do in his personal time?
Well, I've got 4 children, so I'm obviously a taxi driver and a bank, as one does.
A bank that doesn't take deposits, just gives out.
And sometimes they just steal from the bank. There's bank raids. You find your wallet empty and your credit card. Generally, it's credit cards rather than cash now. Have just gone. So that's interesting. We've just moved house about 4 months ago to an old 1914 house we fell in love with when we saw it. We bought it straight away, and I hadn't realised quite how much work it's got. It's lovely, but it has a nice garden, nice big garden, but lots to do. So I'm doing that. I've got a classic car, a 1964 Triumph Herald, who's called James. He's red. And so he is my pride and joy, and I spent a lot of time just polishing him and looking after him, and I do all the maintenance and the bodywork and the engine work and all of that sort of stuff. So
awesome. So
I like doing lots of sort of plumbing and electrics and big kind of practical things like that all the time.
You got your hands full now with a 1914 house.
Yeah. There's a lot. It's a sad story actually, because the architect, he worked for a very famous firm of architects called Voisey Studios, which was the Surrey style of architects, and they were the biggest one, like Lutchins, who was the same. Voisey was equivalent to Lutchins, who was the biggest architect of the time. And this guy who worked for the architect who designed our house, he left the Voisey studio because Voisey became out of fashion. So arts and crafts became less, which is what our house period is, became less popular, and Art Nouveau became popular. So he left, set up his own business, designed our house, went off to the First World War and was killed in the war. So our house is the only house that he designed as his own studio. But he did it very nicely. But we sort of feel a connection to him because we've got all the original drawings, all the original plans were given to us when we built the house.
Cool.
Which is really nice, actually.
So recently, obviously.
About 4 months ago, we moved in, yeah.
Congratulations.
So we've still got boxes in certain rooms. It's not completely box free. There's just a lot. There's just a lot to do. So, but I really enjoy it, actually. So that's sort of what I'm doing.
Nice. Thank you, Tom, very much for your time. It was a great pleasure speaking over here with you. Any closing comments? Where can people find you online?
So look at goldeye.com, you'll find us. You'll see me on LinkedIn. I like chatting on Slack. It's the best way. I don't really like email so much, but you can email me if you like. I will be at the IFX Trade Show. I've got 2 panels. I've got one on cryptos that I am moderating, and I'm appearing on a panel talking about FX, risk and AI sort of together on the first day of the show on the Wednesday. So you can see me there, and you'll see me wandering around. I will be in my purple suit this time.
I was going to comment on that. It would be very easy for people to spot you because you wear these amazing suits at these expos.
So I think it's purple I brought this time.
Purple? There's purple, there's red, there's yellow. I've seen yellow, am I
green.
right?
I haven't got yellow actually, no. I've got a purple, red, bright blue, green, dark green, which I don't wear very often, dark blue, which I very rarely wear. So it tends to be quite bright. So it's going to be purple at the party tomorrow and at the show for the 2 days, which will whiz by, and then I will be off home. So we are based just outside London. Our office in Guildford. We obviously have an office in Shanghai and an office in Sydney as well, and then we have reps in Cyprus as well, selling our products. So we've got very good global coverage everywhere. So we love seeing people in the Guildford office, although it doesn't happen often enough.
Awesome. Thank you so much, Tom. Thank you for your time. See you at the expo.
Thank you very much. See you then.
Thank you for watching. I hope you enjoyed that episode. Remember to hit the like button. Comment down below if you have any guests you'd like me to interview and any topic you'd like me to discuss in future episodes.